Good afternoon, everyone. Welcome along to this session from Manufacturing Northern Ireland. My name's Stephen Kelly. I'm the Chief Executive of Manufacturing NI. Very pleased today to welcome you along to this session about growing your exports safely, alongside colleagues from a variety of business organisations and groups who've been supporting manufacturing in Northern Ireland over the last number of months with the work that we've been doing, particularly on our Manufacturing Month. Very glad to welcome along Nicola Harris, who's a Senior Underwriter at Risk Services with Atradius. Nigel Birney, who's the Head of Trade Credit, at Lockton Companies in the UK and Ireland. We've got Mark Henderson, who's the Trade Finance Director for Barclays Corporate Bank, and Glenn Patterson, who's the International Trade Manager at Invest NI. We're going to run through some quick presentations. We have an opportunity for you to ask some questions. There's a Q&A facility along the top of your Microsoft Teams. Feel free to use that and send some questions into us, and myself and colleagues at Manufacturing and I will try to make sure we get those questions asked for you towards the end of the sessions. This is a really important part of what we do in business. That there's quite clearly evidence that those businesses that sell externally tend to be stronger, tend to be more resilient, tend to be more successful, employ more people, as well as contributing much more to the Northern Ireland economy. And as we kind of move forward with our economy, there's a very clear ask from our government and others to try to ensure that our firms sell more to external markets to increase Northern Ireland's productivity, but to increase the amount of money that comes into and others. But trade flows in two directions. Obviously, and as manufacturers, you know about how difficult and complex supply chains have been over the last number of years. And given the challenges of both Brexit, COVID, and the more recent supply chain crisis and the cost of doing business crisis, never before has it been important to not just grow your business, but grow your business safely. So today's session is about how you can do that, what type of activities and functions you should introduce within your business, a kind of wider picture of what's going on there in terms of global trade, but alongside our partners, what sort of support they can give you as businesses so that you can grow your trade more safely and as a result, more successfully. We're going to run through some presentations. As I've said, we're going to begin with Nicola Harris, who's a Senior Underwriter at Risk Services at Atradius. Nicola, I'll hand over to you, then I'll come back in and introduce Nigel straight after you. Nicola, you're very welcome.
Fantastic. Thank you, Stephen. Good afternoon, everyone. As Stephen introduced, I'm Nicola Harris. I work as a Senior Underwriter to Atradius Trade Credit Insurance. For those of you who aren't familiar with Atradius or perhaps trade credit insurance more broadly, we ultimately protect against the risk of unpaid invoices in day-to-day transactions, the risk of bad debts, and payment and protracted payment defaults. We're focusing today on the export growth market. So let me start by saying that despite all of the doom and gloom that comes with the current economy and all of the current headlines, there are plenty of opportunities in today's market. In fact, if we look at the exports from Northern Ireland last year, we saw really strong growth of 15.3% in 2022. We're on a really strong platform to build on that further in 2023, not least because of the unique position that we're in under the Windsor framework with access to both the European single market and the UK market itself. We've seen businesses leverage this dual market access already. We've seen French container shipping group CMA CGM already increasing their port stops to include Belfast Harbour. So we've got excess capacity and increased opportunities to export directly from Northern Ireland to mainland Europe. Beyond the EU, there's also a number of other trade frameworks that have been signed up to, including the recently brokered Atlantic Declaration with the US, and bear with me because it is a bit of a mouthful, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or the CPTPP for short, which ultimately will bring opportunities for a trading bloc of additional 11 countries. So it's definitely not short of opportunities for growth at the moment, but it's navigating the risks attached to those new trading partnerships, which can be a little bit less straightforward, and what we're going to focus on today. You can see on the slide that's been shared, there's some headlines there for the major trends that we're seeing across the global market. Despite a very turbulent backdrop over the past few years, impacted by COVID and more recently the invasion of Ukraine, resulting energy price crisis that resulted, the global economies generally proved fairly resilient against that backdrop. Last year we avoided recession. We saw business failures rising only 9% in 2022, despite a 29% cumulative contraction between 2020 and 2021. That said, as we're running through to the mid-2023 point, we've seen persistent inflation and tightening credit conditions now weighing on demand. So the outlook is for a nominal 1.7% global growth in 2023. And that's despite China coming back on board and increasing the expectations for growth from Asia. If we look at the manufacturing PMI in isolation, it was at 49.6 in the latest May figures, against a benchmark, where 50 separates the difference between growth and contraction, which reflects that business conditions had worsened for the 9th consecutive month and new order growth had worsened for the 11th consecutive growth. There's varying levels of strains across the markets, but we saw order intake weakest for Germany, Austria and Thailand, where production levels had far exceeded the new order book growth, creating a bit of a deficit on that side. In addition to that slowing growth forecast that we're seeing, we've also got the background of surging interest rates across all major markets. The US Federal Reserve's at a 16-year high, and we saw the Bank of England increase rates to a 15-year high last week as well. These higher borrowing charges are starting to weigh on businesses, particularly those who've got a higher debt burden to service post-COVID, and which is also adding to the additional strains that we've seen in the past few years. If we switch to the next slide, please, our own internal forecast of expecting that these slides are likely to result in weaker resilience in 2023 as a result of the pressures that we've mentioned. These give a bit of an overview of some of the insolvency projections that we've put together. We've got 2022's final quarter on the left there, and on the right, the forecast for 2023 and 2024. Overall, we're forecasting a 49% increase in global insolvencies this year, and that's likely to be followed by a further 12% rise in 2024. And unfortunately, it's not an isolated issue. The majority of countries that we forecast for are expected to show at least double-digit percentage increases in 2023. And that's largely due to a resumption of normal insolvency levels following a fairly subdued period in 2022 because of the level of fiscal intervention that we've seen. The large spread between regions, as you can see, certainly on the right-hand chart, and you'll note the countries have remained in the same order, so we can compare like for like between 2022 and 2023. And I think those red bars give you a good feel for those who've had worse insolvency levels in 2022 or a quicker resumption of normal insolvency levels are expected to fall back in 2023, whereas those who are still catching up are seeing and forecasting higher rates this year and next. The highest insolvency growth this year are therefore forecast for South Korea, Italy, Hong Kong, New Zealand, all of which were countries that had relatively low insolvency levels in 2022 compared to their pre-pandemic situation. We've got a slight breakdown again on the next slide, please, of our insolvency matrix, which plots not just the trend of insolvencies, but also the status of insolvencies against the pre-pandemic position. So you can see that in the left-hand chart, the UK, Italy and Belgium are currently in the most worrisome position of those key markets that have been charted because the trend is deteriorating, but we're also looking to move to above 120% of the 2019 or pre-COVID insolvency level. Now, I appreciate I said it's not all doom and gloom, and there's a lot of negative headlines in that brief update there, but there are a lot of bright spots to be found as well. There are many markets that are expecting relatively low or negative insolvency growth this year, including Spain and Switzerland, where failure rates are expected to contract. Insolvency rates also appear to have stabilised for Austria, Finland and the Czech Republic, none of which are expected to see insolvencies breach the double-digit position this year. So challenges across the board, but certainly brighter spots in certain markets. It's very much a challenge to monitor that on a day-to-day basis when you're managing your business. So we have put together some various aids to help you inform your decision making when you're looking at new export partners. Our payment practices barometer, if we can go on to the next slide, please, is one of these that we put together on a regular basis. It's compiled for all major markets and it monitors the payment performances of real businesses based on surveys we've conducted. The extracts on this slide reflect some of the key takeaways from our Western Europe survey, and on the right-hand side for the Republic of Ireland as well. There's some notable outliers on that first chart there, and certainly if you look to the grey portion of the charted bars, which reflects the percentage of all business-to-business invoices that have been written off as bad debts, Ireland and Switzerland both leading the way in double digits there, with the UK market close behind at about 9%. In contrast, if we look at the lines for Sweden and Greece, the large majority of payments made in those markets are being paid to terms, and relatively few bad debts reported there. It does give you a gauge of which markets might be tracking slightly more favourably in terms of payment performance, and those markets where we might need to be slightly more attentive. I have delved into the Republic of Ireland a little bit more detail, just because it is Northern Ireland's #1 trading partner at more than 40% of last year's exports. And the chart on the right there shows some quite worrisome figures, actually, if you look at the trend in payment to terms. So only 27% of all business-to-business invoices were paid on time in a survey that we conducted, and that's a notable contraction on last year's 44%. With the majority of businesses surveyed reporting a deterioration in payment behaviour. Like I say, we've compiled these for all of our major markets. Unfortunately, I can't delve into everything today, but certainly gives you a snapshot of some of the key headlines that we're seeing. We've also compiled some reports which reflect on the broader economic and political stability of certain markets. And if we can switch to the next slide, it should reflect our quarterly country risk map. Well, I think we may have gone one too far there, apologies. That's it. So this is our risk map, which we update on a quarterly basis. And you can see there the political and economic stance for each of the regions that we've reviewed. With the exception of Russia, for obvious reasons, the vast majority of Europe and Asia are shown in the green shades, reflecting low to moderate risk profiles, as are most of the advanced economies, North America, Australia and New Zealand. We're also seeing some positive shades there for a lot of the emerging economies in Asia, especially China and India, which are both rated as low to moderately low risk. As I say, unfortunately, we're a little bit constrained by the time today, so I can't delve into each of these markets, but I have cherry-picked a few of the more regional updates, which I think are worth commenting on. Turkey last year was a very much a growing market in 2022, and in terms of the exports between Northern Ireland and Turkey, these were up 40% year on year. But of course, we saw the earthquakes hit earlier this year, as well as high sustained inflation in those markets, which is suppressing growth. So it has received a moderate to high risk rating at our latest review, and it remains one that we keep under monitor. I also referenced the CPTPP trade agreement earlier on in the call, and the doors that it will open in terms of trade with Malaysia, amongst other markets. Malaysia only accounted for 0.5% of Northern Ireland's exports last year. It's very much an expanding market, already growing 21% year on year. And in light of the region's moderate to low risk rating, it's a very attractive export proposition in today's market. Vietnam, similarly, also benefiting from that CPTPP, is rated slightly higher as a moderate risk, but continues to demonstrate very strong potential for growth as one of the fastest growing markets, certainly in Asia, but also globally. If you look at Vietnam's GDP growth over the decade to 2020, they were averaging 6% GDP growth per year, and they hit 7.8% in 2022 as well. One of the recently upgraded markets, which I think is shown there in a little bit more detail, is Croatia, which we upgraded to a moderate to low risk in January of this year following their adoption of the euro. Certainly, recovery in their tourism industry in line with the wider aerospace sector is boding well for that region, as are a stable political system and access to the EU recovery fund. So we're forecasting growth of 1.6% in that market as well in 2023. So certainly a number of brighter spots there that would be, like, as I say, strong prospects for export growth. The next slide then, again, limited on the amount of detail we can cover here, but it gives you a little bit of an insight into some of the bright spot reviews that we've done by sector. So these are sector-specific opportunities for growth, specifically in 2023. Some headlines that I'll reel through from the full report include certainly the European automotive market, an area that's had a lot of strains over the recent years because of the semiconductor bottlenecks and wider supply chain difficulties, but is now expected to grow twice as fast as the rest of the global industry for automotive. France leading the way at 13% growth and Germany just behind at 9%. So a lot of easing supply chains there, which are fueling growth, as well as a reduced threat of potential energy rationing in those markets. In the US and Mexico, so if we move over to the Americas, it's the transport sector, which we've identified as the bright spot there, certainly on an upward trajectory following double-digit growth in 2022. Likely to be slightly slower in 2023, but it's helped by momentum from the $1 trillion infrastructure bill that was signed in 2021. In addition to bright spots in Europe and the Americas, if we look to Asia, despite the concerns around China's real estate market, construction certainly in the Asian markets, if we look at the civil engineering subsector, is on a strong trajectory as well. Particularly for Indonesia and Vietnam, we're expecting to see substantial increases in demand this year by around 11% and 7.5% respectively. So I know I've reeled off those fairly quickly, and unfortunately we can't go into so much detail on today's call, but I hope that gives you some example for some of the growth opportunities that are out there at the moment. I appreciate that trading with any new customer, let alone in a new export market and against the backdrop of a potential global recession, brings more than a few hurdles in today's economy. We touched a little bit earlier on the fact that global insolvencies are forecast to increase by nearly 50% this year. And we saw that for some markets in particular, the expectation is that figure is going to hit at least 3 times the global benchmark. So when it comes to helping your business navigate the risks, there are a few options available to you. As I've touched on, we at Atradius provide trade credit insurance to protect your business against the key risk of your customers not settling their invoices. Because after you've gone through all of this effort, not getting paid for those exports is the last thing that you need to be worried about. We cover against the risks of insolvency, protracted late payments and political risks. I'm hesitant that I know Nigel's going to touch on this in a lot more detail, so I won't tread on your toes. But certainly, I would encourage any of you who are looking at trading with new partners, be that export or domestic, to consider trade credit insurance as one option to protecting significant risks and eliminating those from your day-to-day business. Thank you very much for your time on that. I'm conscious we've reeled through fairly quickly, but I'll hand over to Nigel, if that's all right, to run through trade credit insurance more broadly.
Nicola, thanks very much for that. That was fascinating, and I think just the visualization of like your payments protection barometer and those sort of heat maps and stuff really kind of simplify this in many ways for people who are looking at new markets and potential partners, either as sales or as supply chain. Can you tell me where that stuff's available? Do you have to be an Atradius customer to get access to this, or is it publicly available? Or
a lot of the reports that we do are publicly available, so you can access them through our atradius.com and atradius.co.uk websites. I'm happy to send distributions of the latest reports out following this call. We do also offer specific benefits to our insured customers. So not only do you get those insights at the global level and at a country level, but we also offer our insights portal for our insured customers, which reviews buyers on a specific basis, so company by company. We have our own internal buyer rating of 1 to 100 for every company that we review, and that's updated regularly. So it keeps you aware and alert of any potential deterioration in those risks. But certainly there are reports out there that are publicly available and that we can make available to yourselves, and additional insights that we do provide to our insureds as well.
Thanks for that. I'm sure there'll be other questions later, and please do, if you're watching online, ask a question in the Q&A. And we will share both the slides and those other links after the event alongside a recording of this to the wider manufacturing community. I'll hand over now to Nigel Birney, who's the head of trade credit at Lockton companies in the UK and Ireland. Nigel, I'll allow you to pick up from where Nicola's left off there.
Yeah. Thank you, Stephen, and good afternoon, everyone. So we've just heard from Nicola regarding the economic outlook and risk forecast, and I'd like just to take a few minutes to expand on the commercial benefits of credit insurance and how collectively they can provide Northern Ireland businesses with confidence to either take their first steps into exporting, or for those already selling into overseas markets, to increase their sales in these markets and enable businesses to take advantage of, I suppose, Northern Ireland's unique position in the EU single market, recently described as the world's most exciting economic zone. Next slide, Connor. The premise of any insurance product is that it provides protection against an unforeseen future event. And the unforeseen future event in the context of credit insurance is a loss or a bad debt. And although the focus today is on exporting, the benefits of trade credit insurance can equally be applied whether you're selling to a customer in Cookstown, Cape Town, or Blanchardstown. So what is credit insurance? Well, as the slide says, fundamentally, trade credit insurance provides financial protection to businesses selling goods or services on extended open account credit terms, which can typically be 60 to 90 days, should any of their customers default in payment caused by insolvency or liquidity issues. So what are the risks covered? The commercial risks, which are standard credit insurance, which are covered on a standard credit insurance policy, as protection against your customer defaulting in payment because of insolvency or protracted default, where the company that owes you the money are still trading, you're just not getting paid. When you're trading in overseas markets, then it's important to have political risk cover. So just to explain a bit more about political risk cover, you could have a situation where your customer fully intends to pay for the goods that you've supplied, but is unable to do so due to events such as maybe a moratorium where the government suspends money leaving the country, or there's war, civil unrest, or even a natural disaster, which can impact your customer's ability to pay. In credit insurance, industry standard is 90% cover on any debt that you're owed, and this can rise to 95% on political risks. So we just move on then to the next slide, which really goes through the key benefits. Obviously, the fundamental element of credit insurance protection against unpaid invoices. However, there's several other benefits that can certainly be added. Now, credit insurance is a global product, and all the main underwriters in the market, such as Atradius, have risk offices dotted across the globe. So wherever your customer or prospect is, the insurer will be able to provide local market intelligence on the creditworthiness of that customer or prospect. And while cover's in place, the insurer will continue to monitor the financial health of your customer, will keep you updated should your customer's financial health deteriorate, and which you may not be aware of, any deterioration being hundreds or even thousands of miles away. So that is a market intelligence, which is absolutely vital. Confidence, well, credit insurance provides confidence and protection and peace of mind, to allow you to embrace overseas sales opportunities, safe in the knowledge that your outstanding invoices are protected against default and payment by the importer. Cover. There are very few markets that the credit insurance industry doesn't cover, and certainly cover is available on all OECD markets. Underwriters can normally progress requests for cover within 48 hours, which enables policyholders to make more informed decisions and make them quickly. Another very important part of credit insurance is that it allows exporters competitive advantage by allowing them to be able to extend payment terms on open account basis, rather than forcing maybe the buyer to use a more formal method of payment, which can be cumbersome, such as maybe letters of credit or bills of exchange. Next slide, Connor. Another very, sorry, I went one too far there, just back one. Yeah, another very important facet of credit insurance is that most of the main credit insurers, such as Atradius, provide an integrated debt collection service, which is very important to an exporter, given that regulations covering debt collection can differ greatly from one jurisdiction to another. And if you were exporting even into Europe and you had a customer that wasn't paying, you can't really, walk into a solicitor's office in Belfast and ask them to help you collect that debt in France or Germany or wherever. So that's why it's a very important and integral part of credit insurance that this debt collection service is available, because at the end of the day, credit insurance is also a cash flow tool. It's there to get money back into your business as quickly as possible. Bank funding, credit insurance does can provide greater access to working capital facilities, as funders such as Barclays Bank can become co-insured under a credit insurance policy, which offers them increased collateral and be able to provide these working capital facilities that are so important to the growth of businesses. So talking about growth, credit insurance does facilitate growth and allow you to trade safely with new customers and increase credit lines to existing customers. Unfortunately, it does. The reality is, it does happen that customers don't pay, and that's why you have the safety net of credit insurance, which means that any debt, the working capital, can be replaced very quickly, because claims are normally paid within 30 days. There's also an element where you can maybe, with credit insurance, you can afford to reduce your bad debt requirement or bad debt reserve requirement, improving the balance sheet, and again, increasing your working capital. Now, credit management, credit insurance is never going to replace your credit controller, but it'll certainly add discipline to the credit control function. Next slide, Connor. I just want to share a couple of case studies which I would like to share with you, which demonstrate the benefits credit insurance has brought to these two particular businesses. The first is a testimonial from Yolanda Cooper, the founder of a company called We Are Paradox. We Are Paradox was founded in 2019 to offer high-performance, natural, vegan and cruelty-free hair and body care products. And Yolanda testifies how credit insurance has provided her business with confidence to develop these overseas markets, and most crucially, to secure working capital facilities which enable the business to achieve its growth strategy. The second case study is really a more testimonial from Mark Hutchison, the CEO at Hutchison Engineering, and a recent inductee into the Manufacturing NI's Hall of Fame. So Mark explains how credit insurance has given his business the confidence to grow safely. They've used credit insurance now for a number of years, and has enabled the business to make very informed decisions in the creditworthiness of potential new customers, as well as helping him and the business avoid bad debt. And he goes on to say the presence of credit insurance has also supported his relationship, not only with customers, but also suppliers who have the confidence to trade with Hutchison Engineering, knowing their debtors ledger is also protected. So we're very grateful to Mark and Yolanda for validating our message today and providing an insight into how credit insurance is helping them both to grow their respective businesses safely. So thank you for taking the time to join our webinar today. I'll be very happy to take any questions in the panel session at the end.
Nigel, thanks very much for that. And I'll add my own endorsement there to Mark Hutchinson's as well. I mean, I work very closely with yourself as a representative across the industry, and I've been continually impressed by that market intelligence piece in particular, where you have all these inputs coming in about who's doing what with where and who's performing well and who's perhaps as a customer lagging a little bit behind. And that's been vitally important, I would say, in terms of protecting some of my members here in Northern Ireland. And I know not just Mark, but others that are engaged with you in particular and your company have found that probably as valuable as anything else. Been able to kind of either reassure or tell people just to be a little bit more cautious or whatever the case may be. So it's not the primary thing in terms of the product, but it's a very, very, very valuable resource in terms of just having a central place where all this information is coming in through yourself and colleagues in Lockton and Atradius. Just remind everyone, if you do have questions, do put them into the chat at the end. We are recording the session and we'll share the slides and the recording with you later on. I'm going to hand over now to Mark Henderson, who's the Trade Finance Director at Barclays Corporate Bank. And Mark's going to take us through how not just Barclays, but banks in general can support that export growth that we have, including things like your UK export finance. Mark, you're very welcome. Hand over to yourself.
Thanks, Stephen. Afternoon, everyone, and thanks for having me along. So just a quick kind of starter, just to explain what trade finance is very briefly. So it's a variety of funding and risk mitigation solutions that can be used domestically as well, but most commonly in import and export. So I always find this risk ladder is a good way to start off, just to highlight the opposing priorities of buyers and sellers. So every seller wants to get paid in advance. Every buyer wants to pay on open account credit terms. So there's certain halfway houses that exist within trade finance, which give varying levels of comfort to buyers and sellers. So things like letters of credit, documentary collections, avalized bills of exchange, standby letters of credit. Each of them have different levels of admin, different levels of cost and bank credit limit requirements for both buyer and seller. And I'd say that the right time to use these is really specific to each exporter and their respective buyer and market. There's no one-size-fits-all approach, but I'd say it's worth yourselves and any export sales managers being aware of the various options that are out there so that they can be considered during any contract negotiation process. So I'm not going to spend a whole lot of time going through all these different trade finance payment options, because it's pretty detailed and probably pretty boring for the vast majority. But I'd say it's worth asking your bank manager to arrange a call with their trade finance specialist to go through these in more detail. Really what we're trying to avoid is a situation where you're losing out on an export order because you may demand pro forma payment, the buyer's unwilling to give it, and you don't know about the other options that are out there, and that's presuming that there's no credit insurance available on the buyer. So what I was going to focus on today is more, I guess, another reason why export sales might be lost, which is access to funding. So I think Nicola and Nigel have already hit on the fact that exports can involve higher working capital requirements, higher values of payments. There can also be longer shipping times or certainly longer payment terms demanded in certain parts of the world. And over the past few years, we've seen a substantial increase in the uptake of UK export finance support. So I'm going to highlight a few of the ways that their support can be accessed, along with a few examples. You see, I've got a slide here with just some high-level issues for exporters. I think these have been probably more comprehensively covered by the previous speakers. What I would say, though, is that by far the most common reason that we are putting in new and increased funding lines for exporters is because, and particularly in manufacturing, is because of supply chain volatility and the fact that one component for a manufacturer, a shortage of one component, disrupts the whole process. So people are buying more, they're buying earlier, and this is creating higher and longer funding spikes in funding requirements for exporters. So just onto the next slide. So UKEF they're the UK's export credit agency. So their role is to help UK exports grow by increasing exporters' access to finance. There is, you'll see here, there's quite a wide variety of solutions that they offer. I'd say some of them are fairly niche, so I'll be focusing mostly on the general export facility, but I think it's probably worth just giving a quick summary of the other options here. So buyer credit, that is a 5 to 15-year loan for an overseas buyer on an export contract. So it can be guaranteed by up to 100% by UKEF, and this is very much focused on bigger sizes of facilities, so typically 25 million plus. So for the vast majority of companies, it's not really going to be appropriate. There is a smaller version of buyer credit, which is a small buyer's loan guarantee. So again, similar, it's a loan to an overseas buyer, but there's no specific minimum deal size. I know that UKEF have supported facilities as low as £400,000. Different banks will have different minimum sizes of facility they'll put in place because of their internal cost to serve. But even if your own bank has a minimum facility size which is greater than what you're looking for, then there is specialist banks out there that UKEF can work with. So Apple Bank springs to mind, not someone I've ever heard of outside of their kind of involvement in this particular product. They seem to specialise in kind of lower value facilities for small buyer loan guarantees. So this could be a useful sales tool where you've got a buyer who wants, say, 5-year plus payment terms to pay for goods, which will typically be capex style goods rather than working capital. This is something that can be explored and is worth having in your toolkit. Just skipping down to the bottom here and the contract specific support. These are the solutions that were in place probably 5 years ago, before the general support came into play. So these are the contract specific facilities. So there needs to be a high value export contract to which there would be a working capital facility that could be used to fund that specific export contract, or it could be used to issue performance bonds or advance payment guarantees under a specific contract. They do have their place still if an exporter, say, doesn't meet the eligibility criteria for some of the general facilities, the general export facility, then these contract specific facilities can still be used, and indeed we've done that recently for Wrightbus, which is one of the examples I'll touch on later on. But by far and away the most usage of UKEF support these days is via these two in the middle here, the general support for UK exporters, which comes via the Export Development Guarantee, which is essentially a term loan of up to 5 years. But again, it has quite a high floor, typically 25 million quid plus. So it's very much focused on the large corporates and multinationals. But the general export facility is something that's kind of much more accessible and much more useful probably for SMEs. So there is the ability to use the general export facility either for bonding, so performance bonds, advance payment guarantees, or for working capital. So here I guess the key thing to highlight, or one of the key things to highlight about this facility, is that it is a general facility. There doesn't have to be a specific export to which any funding is tied. And indeed, the funding, the working capital loan or the bonds and guarantees can be issued or can be used for domestic purposes as well. So it doesn't have to be, you can issue a performance bond in favour of a UK buyer, or you can draw down some working capital in order to fund a contract with a domestic buyer. It doesn't have to be export linked. The key thing to be eligible is that you need to meet the eligibility criteria here. So it's only available to companies that are based in the UK. So premises and employees in the UK, paying tax in the UK. There's no UK content requirements for goods, so it is possible to benefit from this scheme, despite that this may not apply as much to manufacturers. But if you were sourcing 100% of your goods from abroad, bringing them in and then reselling them, then that would still count towards be eligible for UKEF support here. And indeed, we've got examples of deals where the goods don't even touch the UK. You know, the goods will go directly from a supplier in Asia to a buyer in Africa, but because there is still the kind of the intangibles, the services that are provided by a UK company in facilitating that trade, then that still qualifies for UKEF support. So the main criteria is that a company must have 20% of their turnover to be an export in any of the last 3 years, or 5% in each of the last 3 financial years. So particularly for companies in Northern Ireland, with where exports to Ireland obviously still count as exports, it is quite achievable to meet this criteria, and there's quite a lot of companies that do. I'd say proportionally there's a lot more companies in Northern Ireland that meet that eligibility criteria than in the rest of the UK. The main benefit for a bank here is that a bank can get a guarantee from UKEF of up to 80% of any facility. So we just go back to the previous slide. So banks get a guarantee of up to 80% from UKEF, which means that it gives us the ability to provide larger facilities. So typically, again, there is no minimum on facility sizes here for the General Export Facility, or GEF as it's commonly called. Typically at Barclays, we see facilities of between 1 and 25 million. There is no upper threshold on the facility size. That 25 million guidance is there because of that is the point at which the export development guarantee becomes available. So if there is deals that are greater than 25 million, then we'd be looking at the export development guarantee as well. But the General Export Facility is a revolving facility, so sometimes we will have higher ticket deals that GEF is still the best structure for. I know that there are banks that do offer lower value facilities, so don't take that £1 million minimum as read. That there's a cost to serve for banks, so sometimes there will be a focus on ensuring that facilities are of a certain size to make sure that the bank can still make a reasonable return on any facility. The facilities need to be for a single borrower only, so we can't have group facilities. In terms of the way that UKEF get a return, what happens is that on the lending margin, which is the margin that a borrower pays on any loans that they draw down on a facility, then 90% of that margin gets paid to UKEF on the portion that they guarantee. So that's how UKEF make their return. What we see in practice is the impact that that has on the pricing that a bank has to charge on these types of facilities, you probably see a lending margin which is fairly in line with that seen on a non-UKEF deal, but you might see an annual fee which is slightly higher than normal, and that's to make up for the element of the lending margin that the bank gives away to UKEF. So final point on this slide is just around the delegated authority that is given to banks. So I think there's now I think 7 banks that are signed up to this scheme. So the Barclays, HSBC, Santander, RBS/Ulster, Lloyds, and Virgin Money and ABN have really recently signed up, along with a non-bank lender called Newable. And these banks get a delegated authority from UKEF, which means that we have the ability to apply a UKEF guarantee to a facility as long as certain parameters are met. So very recently, and unusually for UKEF, without any kind of fanfare at all, the delegated authority was increased to 10 million quid of UKEF guarantee and guarantee lengths of up to 5 years in tenor. What that means in practice is that if a deal sits outside of this delegated authority, it means that there's an extra layer of credit underwriting which has to happen with UKEF, which in practice can lead to an extra 3 to 4 months on the timeline of getting a facility in place. Sometimes that is acceptable, or sometimes it's just not workable. And you can be fairly deep into that 3 to 4 month period without having certainty as to whether or not UKEF are going to be credit and pricing approved. So this increase in delegated authority is certainly a good thing, both in terms of the increase in value and the increase in tenor. So just moving on to the next slide. So yeah, where and how could GEF be used? I mentioned already the threshold for 5% of exports in each of the last 3 years, and that could just all be sales to Ireland. It can be used for UK contracts. Goods don't have to touch the UK. Goods can be 100% imported. It doesn't have to be goods as well. We're seeing more and more deals and that relate to services. And that's where, if you look at the UK export stats, that's where the growth in UK exports is mainly coming from. It's export services. So we can become fairly creative in terms of how we evidence exports. It might be that it's goods have gone on a ship to a country overseas, but it might be that that there's alternative export evidence that's available. So just to give you an example, we've looked at where a university might be eligible for GEF because of the tuition fees that they receive from overseas students, or a department store or a kind of tourist industry might be able to evidence their exports via overseas credit card details from tourists that come in and visit their attraction. I touched on the delegated authority and kind of the benefits of that. If we're looking at a deal which is outside of the delegated authority, and we have to go to UKEF for their underwriting approvals, then they'll be looking at not just the credit risk of a borrower, but they'll also be looking at what they call the export story. So how is their funding going to be used to increase UK exports? How many jobs will it create? As much kind of detail and story around that as possible, and more these days the ESG story is becoming more important, potentially equally as important as the export story. So that's something to bear in mind. These facilities can be used either to fund working capital or capex. The capex piece is probably a lot rarer, and it's something that hasn't been done an awful lot, but it can theoretically be done. But typically these are working capital facilities. We have seen, sorry, for the working capital facilities, typically these are used to fund purchases of goods bought from suppliers. But we have, certainly at Barclays, we have done deals where, because the labour content and more recently energy costs are such a big part of the cost of sales for a manufacturer, we can also look to fund an element of them as well under these facilities. I mentioned the fact that these can either be used as working capital facilities or contract bonds. So, sometimes bonds and guarantees can be viewed as it's a necessity. If you've got a buyer that is insisting on a performance bond, then you have to give it reluctantly, and you have to pay for the privilege. Now obviously it'll be beneficial to ensure you have a facility that enables you to issue these bonds if required. But we have seen some customers and companies actually take a more proactive approach and kind of look to obtain a larger bonding facility so that they and their sales team can go out and kind of proactively demonstrate that they are able to offer a performance bond at potentially, say, a higher value if it's working with a company that you have got a trust in to not make any unfair claim on bonds. Similarly, that bonds can be used as a working capital tool as well. So you can negotiate payment terms such that you get a higher advance payment at the start of the contract. The buyer is likely going to want an advance payment guarantee in order to protect themselves. But you can then use that advance payment as working capital for your contract. We can also see the bonds being used as trade debt guarantees. So, for example, if for whatever reason your supplier has previously had credit insurance on you, but potentially there's a change in the market and they're not able to get the same limit on you as before, or you're buying more from them, but their limits can't extend any further, then a trade debt guarantee can be used as a top up to credit insurance. It gives the supplier the ability to call on the guarantee if you fail to make payment to them on the agreed contract terms. We're seeing companies use these facilities in a few different ways. There's companies that are using it to get to stretch their facilities beyond where their bank could previously agree. But there's also companies that are kind of taking a look at this and thinking, okay, well, there's a way here for me to get increased facilities from my bank without my bank taking on any more risk on me as a company. So it's therefore preserving capacity for a future request. That future request could be something that is known, or it could just be kind of keeping some gas in the tank for the unknown. Worth flagging that I touched on the increasing importance of ESG to UKEF. They do now have a fossil fuel policy, which can potentially restrict their support. So if you have export sales that are greater than 5% to fossil fuel related companies, then there's a kind of a qualification criteria that has to be undertaken. So it might be that the kind of involvement in the fossil fuel sector would mean that you were not eligible for support. And similarly, despite Brexit, the EU state aid rules still apply. So there is some tests around the balance sheet, accumulated losses to share capital and debt to EBITDA. But the vast majority of companies that we do look at don't hit those state aid rules. Just moving on to the last slide. sorry, just on to the last slide, please. Oh, the disclaimer, right. Okay. Okay, so I was going to just touch on one other point around Jeff, actually, and just yes, here we go, bank considerations. I was thinking that I hadn't included that slide, but there we go. So what will a bank look at when they've got a potential Jeff deal for a client? It's important to bear in mind that the bank gets an 80% guarantee from UKEF. Okay, so that means that obviously there's a 20% element that is unguaranteed. It's not possible for a bank to get fully secured on that 20% element because there is a security sharing arrangement between the banks and UKEF. So there will always have to be an element of unsecured risk for a bank. So a lot of our typical lending considerations apply. So the information that we'd look for, you'd typically be looking for a three-way integrated forecast, the P&L, balance sheet and cash flow. And that's not necessarily to kind of hold a customer to, you know, or you've not met your forecast, what's your facility is going to be taken away. It's more to kind of demonstrate that there is a genuine funding need here, and any facility we put in place is the right size. So there's the right level of headroom based on what the forecast usage is. We'll also look at the individual trade cycle of a client. So a strong trade cycle can enable us to push our funding higher. So things like credit insurance on your debtor book. If there's a high level of confirmed orders that are in place at the point that we are funding, that's helpful. And again, looking at any secondary use of the goods or the quality of any buyers that are in place. We can look at seasonal limits if the funding is not required throughout the whole year. And we can also look to refinance existing facilities if that's required. I'd say the last bullet there is around subordination. What I mean there is if you were talking to another bank about potentially putting a Jeff facility in place whilst retaining your main banking relationship and potentially any security with another bank, that's going to be very difficult for a bank to agree to that because of that security sharing agreement with UKEF. It'll be tough for a bank to live with being subordinated to another lender. So typically we see these deals being done whereby it's the main house bank for a company that is providing the main facilities and any Jeff facilities as well. That's me. Thanks very much for listening, and happy to take any questions at the end.
Mark, thanks very much for that. Can I just ask one question, just for clarity there? The Jeff facility, the general facility, did you named some of the banks that can participate in that? There's very few of them would be kind of regarded as our high street banks here in Northern Ireland. Is that correct?
Yeah, that's correct. That is correct. Yeah. I know that. Yeah, being frank, we get quite a few intros from UKEF because they're speaking to companies that bank with one of the high street lenders in Northern Ireland who at the moment can't offer Jeff. So it's a bit of a competitive advantage for those banks that are signed up to it, certainly.
Okay, thanks very much for that. Just a reminder, if you do have any particular questions, feel free to add those questions into the Q&A and we'll get them covered before we finish up in about 15-20 minutes time. I'm going to hand over now to Glenn Patterson from Invest Northern Ireland. Glenn's the International Trade Manager at Invest. Glenn, you're very welcome. I'll hand straight over to yourself.
Thanks very much, Stephen, and good afternoon, everyone. As Stephen said, my name is Glenn Patterson, and I'm an International Trade Manager here within Invest Northern Ireland. It's great to be here, and thank you to your partners, Manufacturing NI, for the invitation to take part in the webinar.
It's really great opportunity, you know, for us all to outline the vast range of complementary information and supports available from across partners who are taking part today, and to discuss what Invest Northern Ireland has to offer to Northern Ireland businesses at every stage of the exporting journey. Invest NI works with many economic development partners and with many organisations across Northern Ireland. And one example of this is our partner, Department of Business and Trade, through its Northern Ireland hub. And this gives us local businesses very well connected teams across the globe. And indeed, some of our Invest NI overseas teams are co-located with the Department of Business and Trade teams in various markets around the world, as well as our established overseas offices. We've also recently opened a number of new offices, which include South Korea, France, Italy, Denmark, the Netherlands, Europe, and India. At the core of all our trade partnerships is a fundamental shared objective of enabling Northern Irish businesses to succeed in exporting. So just to move to the next slide, please. You know, I'd like to give you a quick whistle stop run through of our exporter support from Invest NI and what we have to offer. There's quite a bit of information to cover in a short space of time, so I would try to keep it as brief as possible. And what I've done is I've grouped it into 3 key areas, which are potential support for potential exporters, support for early stage exporters, and a support for expanding businesses. If you could just flip to the previous slide, I think it is, Connor. You've went on to one too many. You'll also see from our contact details on the last slide as well. I've put my contact details there. So if you have any queries, please drop me an email at any stage or give me a call, and hopefully I'll be able to help you there as well. If we move just on to the next slide now on potential exporters. For those businesses thinking about selling beyond Northern Ireland for the first time and want to explore what it entails, what to think about, how to get started, and the support available, there are a number of channels to get you on your way. We'll start off with Invest NI's Business Support Helpline. This is a free advisory service for all full spectrum business related matters, and it's just a phone call or an email or an query. There's a query sheet there as well to get in contact with them. NI Business Info is also an online channel for business advice and guidance provided by Invest NI that covers a vast range of topics and issues, and also signposts to relevant support from a range of partners and providers, not just Invest NI. For example, with information there on the Institute of Export, Manufacturing NI, NI Chamber of Commerce, through to DBT and their UK Export Academy. And it's also where you'll find Invest NI's Export Health Check to help assess your export readiness. NI Business Info is a resource used by thousands of businesses of all sizes and stages of growth across Northern Ireland every day, and specifically the export information guidance alone on NI Business Info has an average of 260 views per day. So it really demonstrates that it's considered the go-to resource, or one of the go-to resources that's used extensively by our exporters. Then for those businesses looking to undertake market research in preparation for entering new markets, Invest NI's Business Information Centre provides country profiles, sector research, company databases, information on tenders, and guidance on import-export procedures, all to help local companies develop their markets, identify export opportunities, and find new customers. This service is used by about 1,000+ businesses every year, and it's a free to access via the Business Support Helpline. On the investni.com website, we also have a library of webinars, tutorials, and market spotlights sessions for companies to tap into. And finally, to keep up to date with developments of all our resources and news, I would encourage people to sign up for Invest NI's 2-minute update, which is on investni.com. As there's a lot of information coming online and something new's happening there every week. So just in terms of move on to the next slide, support available for early stage exporters. And I mean businesses that are new or relatively new to exporting, but whom are selling, outside NI. And it's a strategic choice and they're committed to it. This is where, in addition to support laid out on the first slides, Invest NI support is all about building skills and capability for exporting. And it's this stage at which our advice, guidance and support comes more tailored to individual businesses' needs. So at this stage, we offer a range of programs that include bite-sized practical export skills workshops. And these are normally 1 day or half day sessions. And it depends on who the partner is we're working at. And they're on specific export targets. It could be export documentation. It could be doing business through social media overseas. And these are often delivered, as I mentioned, in partnership with the Chamber, the Council. An example of this recent one was with London Dairy and Causeway Chamber of Commerce, and we delivered 6 exporting capability webinars, and these were attended by over 150 businesses. We also offer market focus programs that combine classroom learning, tailored mentoring, and peer-to-peer networking. And market visits such as the Grow Beyond program, which is all about selling into neighbouring markets of GB and the Republic of Ireland, and our Going Dutch program, which focuses on researching the market for those businesses looking to take the first step into selling into mainland Europe. And again, the Netherlands, we see it as a great export starter market. Our pitch optimization program is also a popular, challenging program, which is focused on helping businesses maximize the impact of their sales pitch to potential buyers. And finally, the Graduate to Export program, which matches up local businesses to take forward an export market focused project over the course of 18 months. And it's a great opportunity for both the graduate and the company. So the graduate spent 6 months in the business learning about the business and 12 months in market carrying out a market research project for the company. And Invest NI would fund the salary of the graduate, part salary of the graduate, to say. And what we also do there as well is we offer the whole training course free. It's in conjunction with the University of Ulster and with the Institute of Export. So early stage exporters are usually customers in our regional office network, and we'll typically have a relationship with an Invest NI client executive to support their overall growth needs. And again, they would also have access to a dedicated Invest NI trade advisor. The trade advisor provides one-to-one advice to early stage exporters and is there to help them plan their export journey and to navigate the range of support available to them. Trade advisors can also offer specialist services such as the trade advisory service, which offers bespoke marketing support and market research and sales prospecting, and undertake specific for a business's needs. And when relevant, trade advisors can also then offer direct financial products such as the Trade Accelerator Grant to help early stage exporters implement export market development plans. But for those businesses that are not currently customers of our regional office network, last year we launched an Ambition to Grow program to attract more companies into regional network customer portfolios and to top end the packages of financial and advisory support that we offer. I'll just mention the Ambition to Grow program. It's targeting at startups, micro businesses and SMEs in manufacturing and in international tradable services that have plans to increase their sales outside Northern Ireland and create employment as well. It's a competitive program and applications for the current cohort have just closed on the 16th of June, but the next call is due in around autumn this year. And you can find out more details on that at investni.com/ambition to grow. So if we just move to the growing exporters slide. Okay, and finally, we've also worked with support relatively experienced exporters, by which I mean local businesses who've been selling to several markets for a number of years and who are seeking to develop new markets and also build capacity with new customers in overseas markets. In addition to access and relevant support, as outlined in the previous two slides, these exporters can really benefit from the advice of a sectorally focused international trade advisor who work directly with the company, helping them develop comprehensive export development plans that are also sort of weave in support from Invest NI, and we can also tap into other partners' support that is out there as well. Invest NI's Trade Accelerator, or in conjunction with the Client Executive, is also a good way. It's the Growth Accelerator program to tap into overall support from Invest NI. And growing exporters can also access a range of solutions, and this includes overseas events, exhibitions, programs, which comprise of, we do up to 50 events around the world each year. These would be group onward missions and exhibitions on Northern Ireland group stands. And sometimes we also partner with DBT, Department of Business and Trade, and other regions as well on their stands. And on the flip side, we're also seeing an increased appetite in overseas buyers coming to Northern Ireland to meet with potential suppliers here on inward visits. And again, these are sectorally focused opportunities for growing exporters. Looking beyond Northern Ireland and our overseas networks, and I mentioned some of the new offices earlier, Invest NI has an overseas network of 30 offices, and these are spread in 4 territories around the world: in Asia Pacific, GB in Europe, the Americas, India, Middle East, and Africa. Our teams overseas also provide one-to-one support for exporters, and this leverages on-the-ground knowledge, networks, and connections to undertake market research, generate new sales leads, and it makes they also make network introductions and develop market visit programs for business-to-business meetings. So feedback from companies has been very clear that having this type of hand-holding resource, local market knowledge, boosts their confidence and know-how when exploring and developing these international markets. And again, that's been part of why we've opened additional offices there to support these businesses. And finally, our overseas offices also have a role in identifying and leveraging Northern Ireland diaspora community around the world by developing our NI Connections network of diaspora in key sectors and territories. We already have strong diaspora networks in key markets, and this supports NI exporters by opening doors for them and making connections where they'd never be able to maybe get a foot in the door with a particular network or a connection in that market. And we're also continuing to build that network further throughout the world. Just to move on to the final slide. So as I said at the outset, that's a lot of information covered there in quite a short space of time. But I really hope that even if you haven't retained all that detail, that the key takeaway from this is that, and from other presentations today, is that there's a wealth of information and support out there for businesses at every stage of the export journey. And I would encourage you all to tap into this. It's a great offering for Northern Irish businesses to avail of. And many thanks again. And as I say, my contact details are there. If you have any further thoughts or queries, please reach out. Many thanks.
Glenn, thanks very much for that. Quick question from me. I mean, how closely, you've heard today from Atradius, Lockton, Barclays, how closely do you in Invest work alongside those professional services, advisory firms, firms that kind of facilitate that international trade?
Yeah, well, what we tend to do is, rather than, we do have contacts in the various firms, but we would use UK finance. We have Liz McCrory, who would be seconded in the Invest NI. So if a company needs advice and guidance on specific where to go for insurance, where to go for various aspects of exporting, especially on the finance side, we will signpost them to Liz, and Liz will actually sit down with the company and go through that with them.
Thanks for that. A couple of questions, Nicola. Maybe just start with yourself. I mean, you put out some figures there at the beginning, which said that Northern Ireland exports were up 15.3% in 2022. We know that our government's published its own figures just for 2021. I mean, can you give us a little insight into where you get those figures from? Is this work you've done with, I think it was Oxford Economics or others?
I think those figures are from DFE, but let me double check that and come back to you before I wrongly quote myself. But yeah, certainly in terms of the outlook for 2022, quite a strong figure there against what we've seen across the rest of the market, given all of the challenges. So certainly a good foothold for going forward into 2023.
And I'm glad you said that, because that's actually the point I was going to come to here, which is that Nigel referenced it himself, that we have a unique opportunity here in terms of market access, and it's about capitalizing on that. I know the Prime Minister himself is very keen that we demonstrate that we are the most exciting economic zone in the world. I always put a question mark towards the end of it, because it's more than just market access that's at play here. So from us, I mean, those figures are very positive, and if we're seeing really important partners like Atradius having confidence in Northern Ireland because of that market access piece, seeing the growth that's happening with our goods exports in particular, then that bodes well for the future. And hopefully you do have confidence as a firm in terms of this place to do business. Nigel, very few know as much about what moves and moves safely in Northern Ireland than in this area than yourself. I mean, what are the kind of key mistakes that people make? And secondly, what are the key actions that people should take themselves in terms of ensuring that they have support of people like Lockton to facilitate this trade?
I suppose maybe it's not a mistake, but probably one of the key concerns when a company is considering exporting is, the perception is the further your customer is away, the more risk is attached to not getting paid, which is not always the case. So certainly credit insurance can break down those barriers. We have to emphasize the level of information that is now available across the whole credit insurance underwriting network to be able to encourage and give local small businesses, SMEs even, the incentive, the encouragement and confidence to start taking, even in their initial steps into exporting. Sorry, so what was the second part of the question, Stephen? I missed that one.
Well, you've actually answered it with the first part, so you've kind of linked the two of them together. So what are the biggest mistakes, and what are the kind of things that people really need to kind of focus on? So that availability of good contemporary information. I mean, we have firms here who are looking to sell to customers across the border and further afield. You help them with that market intelligence piece and the products to do that safely. The same thing happens in the opposite direction, I would assume. So actually having good information circulating about your firm and about your business and showing that it's a safe business is probably very valuable as well, I would assume.
Absolutely, and people like Nicola and Atradius, they, what we need to encourage local businesses is to engage with the likes of Atradius and provide them with management information and up-to-date management information. So when a supplier wants to supply a business in Northern Ireland, that they can also access credit insurance on the Northern Ireland business and be able to offer them extended payment terms to ease any pressure on cash flow. So the message I would give to Northern Ireland businesses is to reach out through ourselves to underwriters, provide them with information, provide them with regular MI, so there is transparency and visibility, and that gives underwriters the confidence, the right cover, and increased credit lines on local businesses.
And just picking up on that piece there, Mark, in your presentation towards the beginning of it, you talked about firms were buying more and buying earlier because of just what was been happening with supply chains and COVID, Brexit, and other disruptions. What's the picture looking like now? Is that continuing to be the case? Because obviously, if you bought 1,000 widgets and it cost £1,000 5 years ago, because of what's been happening with supply chains, those 1,000 widgets now cost £2,000. So the cover and and the support
Yeah.
required is more, but you're actually still selling the same amount of stuff.
Yeah, I think there'd be, if you kind of changed your, your whole stock holding profile and strategy, then, I think you're fairly brave to change it back again, just because things have got a little bit better and in terms of timings. And I think the feeling I'm getting from a lot of companies is that this is a change that's here to stay. And yeah, the cost of goods has gone up now, but that's just another reason to ensure you've got sufficient liquidity in place, and maybe you need to look at your bank facilities again. But certainly the kind of uncertainties around supply chain don't seem to be disappearing. Some aspects of it have got better, like shipping times have got better, availability of containers has got a little bit better, but there's still that kind of fear that the supply chain crisis showed that things can come to a halt pretty quickly if you don't have everything in place and have enough spares of all the components you need.
And Glenn, thanks for that, Mark. And Glenn, from obviously Invest have had a difficult period, let's put it that way, over the last short while, and we're all waiting for our government to return so that everybody gets the kind of right direction, or pointed in the right direction, and clarity about the direction that they want us to point in, for that matter. But the fundamentals remain. Those businesses that sell externally to Northern Ireland not only bring a good source of income into Northern Ireland, but they tend to be stronger firms, more resilient firms, faster growing firms, etc., etc., etc. What's Invest experience with those exporting businesses in terms of their resilience and stability and success?
Yeah, I mean, in terms of, I would deal mainly with a lot of early stage exporters and preparing them and giving them the capability to move forward. And I think that's at the heart of what we do. We try to work with the company and identify where their needs are, what's going to help them get into those markets, and we try to put that in place for them, depending on what the company's needs are. In terms of resilience, I mean, Invest NI, as you've probably seen our figures out there recently, exports are growing across Northern Ireland. I mean, one of our easy access markets that I mentioned there was the Dutch market, the Going Dutch program, and our exports are up 28% to the Netherlands in the last, since 2021. So they are increasing. So businesses are resilient. What they're doing is they're trying to find new ways of doing things. They're looking to source new product elsewhere as well, or source product locally. So yeah, they're pretty resilient. Have I answered that, Stephen, or is there?
Yeah, no, that's great. And there's a question in the Q&A just to kind of finish off on. Obviously, the UK has the Department for Business and Trade. Northern Ireland has Department for the Economy and Invest NI. Councils have roles and functions. It's a very crowded field. So if you were given one piece of advice for a firm that's not currently exporting, but wanted to begin, where's the entry door for them? What's the quickest, simplest, easiest route to get the support they need?
It is very difficult. I mean, it is a very crowded space, and we've tried over the years to demystify that for businesses. So we have, but what I would say is we have a business information helpline there. And if a company isn't sure about where they should sit, those guys in the information helpline are very, very good. And they've got good connections there with the other economic development partners who we would work with. So what I would say is give those guys a call in the first instance. It's free. Have a chat with them, and as I say, they will hopefully get you to the right economic development partner that can help you.
Everyone, thanks so much for your contributions today. You brought real clarity to and demystify what many people may be fearful of. So actually, externalizing your business and growing it safely is important to them as they kind of decide where they deploy their capital and their resources. So you've managed to assist me, and I'm not the smartest tool in the box. So if I'm in a better place, then hopefully others are as well. As I said, we're going to share the slides, share the contact details. share the recording, not only with people online today, but the wider manufacturing community as well. Thank you so much for your contributions. It's been incredibly helpful, and have a great afternoon. Thank you.
Thank you. Thank you.
Thanks, everyone.
Thank you.